What I noticed recently, and this is really important, is I saw a chart. I might be able to pull it up on the screen for you. No, I don't have it available. But basically, it was a chart. Happy to show you guys if you reach out to me later. And it was from 1926 to 2022. So almost 100 years of data. And it was like a graph chart, okay, like this, like a quadrant chart. And it had stocks and bonds. And it had all these years plotted, you know, just all over the place like this, right? And down here in this lonely quadrant was 1931, 1969, and 2022. 2022 was one of the worst years on record. It was the worst year on record for the bond market. It was the sixth worst year since 1926 for the stock market. 2009 was the second worst year for the bond market. But the reason I'm showing you this is because I got something very interesting out of it. I know you probably already think that I'm not a huge fan of the Wall Street machine and how it works. I mean, the truth is, I believe it is a vehicle designed to siphon money off the middle class and give it to the institutions. This is a mechanism for doing that. Because the truth is that over this almost 100 years of data, only 36.5% of those years did stocks and bonds move in opposite directions. So it's not a symptom of stimulus alone. In fact, just to kind of give you some more insight into what I just said, I know it makes me sound like a conspiracy theorist, but you can draw your own conclusions once I share the data with you. But you guys are all, I'm sure, very familiar with what I'm about to draw on the board. I'm gonna have to figure out a way to get this to erase faster is what I'm gonna have to do. Okay, that's good enough. So everyone's somewhat familiar with this because this is the Wall Street approach. You see it all the time. They have these 5 risk tolerance categories, right? And anytime you meet with an advisor or a firm, they're going to try and figure out which box you fit into. You've got aggressive, moderately aggressive, moderately conservative, and conservative. I'm sure this is looking familiar to you. And really what that ends up looking like, because almost every firm out there uses this, we don't, but almost every firm does. And that's that if you're a moderate investor, you might have 50% in stocks and 50% in bonds. If you're moderately conservative, well, you might have 40, 60. And if you're conservative, you might have 15% in stocks and 85% in bonds. Then it goes the other direction. Moderately aggressive is going to be a 60%, 40%, and aggressive 85, 15. This is a system that's been around for a long time. But it's kind of interesting when you really zoom out and think about what this means. You know, they teach you that bonds are the safe asset. And of course, for a long time, stocks and bonds were moving up together. Nobody was complaining about their correlation not being what it was supposed to be until 2022, when both stocks and bonds went down together. We're going to see more of that, by the way. But what you see here is an asset class that they teach you is a safer asset class. But we already know, if you remember, the teeter-totter or seesaw on how bonds work, right? As interest rates go up, the price of the bonds that currently exist lose their principal value. Well, what do all these financial planners and advisors recommend as you get older, right? You should be moving this direction towards conservative, right? Which I do agree with that by the definition of these words. However, I don't agree with this methodology, which is as you get older, you would be loading up more and more into an asset class that is very vulnerable and not well understood by most of the investing public. You know, I think it's a very important thing to be aware of. So I have actually, I'm going to try this. See if I can get it real quick. Oh yeah, that's much better. So we've come up with a different approach that I can't take all the credit for it. A lot of the stuff that we do I kind of took the best of what I found out there, the best stuff for clients, and designed a firm around it. There's a few things that I can take credit for that I designed myself, which we can talk about individually if you'd like. But I will say that I think that this approach is a lot simpler and a lot more effective.
Click the card in the corner of the window to continue this webinar. Please remember to like this video and subscribe for more educational content.